It's a wonderful good morning, good afternoon, good evening, depending on the part of the world you're joining this call from. The management is represented today by Dr. Shervil Patel, the Chairman, Mr. Tarun Arora, CEO, Mr. Ganesh Naik, Director, and Mr. Umesh Parikh, CFO. At ISEC Institutional Equities, we cover Zydus Wellness, and we have a constructive view on the business and the stock. Now, over to the management.
Hi, good evening, everyone, and welcome to the post-results teleconference of Zydus Wellness Limited for Q4 financial year 2021-22. We have with us Dr. Shervil Patel, Chairman, Mr. Ganesh Naik, Director, and Mr. Umesh Parikh, CFO. As the economy is witnessing high inflation in the food and commodity prices, our key inputs like milk and refined palm oil are on continuously rising trend and see no sign of abatement. The rising level of inflation has impacted consumer sentiments and affected consumer demand. Since the company commands reasonable pricing power for most of its brands, it has been able to take calibrated price increases over the last couple of quarters and balance the cost and profitability. During the quarter, the company has posted net sales growth of 5.7%, which includes volume growth of 0.4%. Our gross margin as percentage to net sales has sequentially improved by 265 basis points on the back of price increase and cost improvement measures. Amidst the spread of COVID-19 during the last 2 financial years impacting the summer-heavy brands, our net sales on the 2-year CAGR basis posted a growth of 7.1% despite the erosion of around 8 to 9% of total annual revenue each year. For the financial year 2022, we have achieved a growth of 7.3% on net sales and 7.6% on total operating income, respectively, over previous financial year. Despite the challenges like COVID-19 and inflation, company has been able to navigate through these headwinds by taking appropriate measures and match last year's performance and in terms of EBITDA. Let me take you through the highlights of the consolidated financial performance of Q4 financial year 2021-22. During the fourth quarter of financial year 21-22, our total income from operations grew by 5.6% to 639.8 crores. EBITDA was down by 2.7% year-on-year to 1,415 million rupees. PBT was down by 0.9% year-on-year to 1,314 million rupees. Net profit was up by 0.1% year-on-year to 1,333 million rupees. Coming to the annual consolidated financial highlights, our total income from operations increased by 7.6% year-on-year to 2,009.1 crores rupees during the year. Our EBITDA was up by 0.1% year-on-year to 344.8 crore rupees. EBITDA margins as a percentage to total income from operations stood at 17.2%. PBT after exceptional items was up by 172.7% to 306 crore rupees. Reported net profit was up by 160.1% to 308.9 crore rupees. Adjusted net profit was up by 23.1%. Our consolidated cash position stood at 196.8 crore rupees, including investments made in liquid funds. Our consolidated capex for the year was 66.9 crore rupees. With that, let me share some of the highlights of operations for the year gone by. We continued our thrust on marketing initiatives to grow the categories and increase market share of our brands during the quarter. To narrate a few, on the Glucon-D front, as highlighted earlier, there was a steep shortfall in sales due to second wave of COVID-19 in the peak summer season, However, early set-in summers in the last quarter of financial year in the key markets has helped the brand recover and post a double-digit growth for the financial year. Immunovolt, which continued to deliver steady business, was supported with TV campaigns and distribution drives. Glucon D has maintained its number one position with a market share of 58.5% in the glucose powder category as per MAT March 2022 report of Nielsen. On the Complan front, as per Nielsen, the health food drinks category has slowed down over the last 3 quarters with flat to negative growth over comparable previous year. The category reported 2% degrowth in the last quarter for the financial year, which impacted the business. During the year gone by, the brand has relaunched with an improved taste and pack design and strengthened the position by not just focusing on growth but also on memory and concentration. The relaunch was supported with its new campaign, Umeedon Se Aage Badhne Ka Plan, which communicated the key benefits of the brand. During the last quarter of the financial year, we relaunched the new campaign, Pack Palto Fark Dekho, emphasizing on its narrative focused on right nutrition leading to better growth. The brand's market share stood at 5.0% in the health food drink category as per MAT March 2022 report of Nielsen. On the sweeteners front, the overall sweeteners portfolio grew at mid-single digit growth owing to higher base of the previous financial year. However, the portfolio posted a good double-digit growth on a 2-year CAGR basis. The category is facing challenges as higher proportion of diabetics succumb to COVID wave 2, thereby putting pressure on related consumption. We onboarded a new brand ambassador, Ms. Katrina Kaif, along with a new campaign. The future-focused stevia-led range of sugar-free green registered a high growth rate and it has helped drive the e-commerce first approach. The sugar-free brand is firmly holding the ground and the company's market share stood at 95.7% as per the MAT March 22 report of IQVIA. Sugarlite continues to grow at a high double digit during the year with consistent support on above the line and digital front to recruit new consumers into the healthier sugar segment. On the personal care front, Everyuth brand outpaced the category growth and registered a strong double-digit growth during the financial year gone by. The brand launched a range of body lotions in Q3 and continued to build new range along with the core portfolio of skin cleansing with consistent ATL inputs on TV and digital platforms. Everyuth Scrub has maintained its number one position with a market share of 39.0% in the facial scrub category, which is an increase of 367 basis points over the same period last year. Everyuth Peel Off has maintained its number one position with a market share of 76.2% in the peel off category. Everyuth brand is at a number 5 position with a market share of 6.5% at overall facial cleansing segment level. Nycil brand sales got impacted for second consecutive year due to second wave of COVID-19. However, the brand continues to maintain its strong leadership position in the prickly heat powder category, supported by consumer offers and ATL initiatives. We are looking forward for a good summer season this financial year, which will help us continue gaining market share. Nycil has maintained its number one position with a market share of 33.7% in the prickly heat powder category. On the dairy and spreads category front, Nutralite brand delivered a strong double-digit growth during the year. In the spread category, mayonnaise business has doubled compared to previous comparable year. Nutralite Doodh Shakti dairy portfolio, which was impacted immediately after launch due to COVID second wave, has started getting traction in second half of the year. It was well supported with TV, print and digital campaigns. Nutralite Doodh Shakti Professional Ghee was launched in March 22 to expand its presence in the institutional and food service channel. On the international business front, the company continues to expand its international footprint by entering new geographies like Hong Kong, Lebanon, Zimbabwe, Muscat, Ethiopia and Australia during the financial year. The company also launched new extension to sugar-free, that is sugar-free delight cookies and sugar-free delight chocolate spread in international markets. The international business continues to grow at high double digits Unlike the last two financial years, the company anticipates normalized year with good summer season aiding its summer heavy brands like Glucon-D and Nycil and consolidate the performance of other brands. The company expects to see improvement in gross margin through a mix of initiatives outlined earlier in the coming quarters. Though the inflation will continue to be a concern, company is confident of navigating the challenges with a clear focus on driving growth and balancing the bottom line aspirations with a combination of cost improvement measures and calibrated price increases. Thank you, and we will now start the Q&A session. Over to the coordinator for the Q&A. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Kapil Jagyasa from Edelweiss Financial Services. Please go ahead.
Thank you for taking my question. Sir, can you throw some light on the Complan market share? I believe it was 5.5% when we had acquired it, and now it is down to around 5%. So, are we losing value market share over here, or is this a case of segment itself not performing as per expectations?
So, in the second quarter of 2019, soon after acquisition, we had touched 5.0. We have seen share going up to 5.5 and 5.7 and coming back to 5.0. We've seen a little bit of yo-yo and more so impacted over last couple of quarters. We've had a good double-digit growth prior to that, and I think it's largely an impact of two factors. One is the category growth has slowed down, but our own performance also impacted by price drops taken by the leader in launching their pouch pack. We are pretty confident by our relaunch actions that we will be back at regaining market shares, but there has been a little bit of back and forth on the shares, but it's in the same zone as we acquired it.
So, would we be following the leader strategy over here? Would we be also be going for price declines in this, price cuts in this segment?
So we are not following the leader strategy. What we are doing is actually two or three things. One, in the relaunch, we have focused on the brand building, where we are focusing on the proposition around overall growth, which is beyond physical growth that we stood for. We are focusing on memory and concentration. We have also improved our taste and impact of the brand. However, to navigate the changing market scenario, we will be addressing the pouch and sachet, but we will do it not exactly following the leader, but we are testing some pieces. We've already launched a pouch pack in West Bengal for our Creamy Classic, which addresses part of the pricing challenge, but not exactly following the leader.
Okay, thank you. So, my next question is, how is the traction in your seasonal products like Glucon-D and Nycil? Now, we lost 2 summer seasons because of COVID. Now this summer has really turned on well, and there has been no COVID cases, especially in the March, April, and this May. So, how has it turned out? Because this ice cream and carbonated drink players are doing really well. So, your inputs on this?
So summer season came a little later, but I think, well, I cannot share beyond a point, but yes, what I can say is our experience in end of the last quarter was very positive. So we are hopeful that we still have some time to go for the season to complete, but it has started off well, and we'll see how it plays out.
Okay. And sir, just last question from my side. Would you continue to take price hikes to maintain your margins? And if not, would there be cut in A&P spends going forward?
So we are looking on the prices brand to brand, and we have covered cost issues for each of the brands other than Complan, where we may have to respond to the competition and the milk prices are zooming higher. So there we may take a portfolio call and balance it out, but we are consciously looking at calibrated price increases to balance our portfolio and hold on the margins, gross margins and EBITDA margins. I think we will, the focus on advertising is to continue building the brand, and therefore it is usually the last call to manage the operating margins. And I believe if at all, those are tend to be temporary or calibrated again.
So, sir, can we expect gross margins to revert back to around 55-56% by end of FY23?
Our intent is to be doing that, but hard to say because every quarter we've seen some new challenges and very hard to predict the way the world is. It's absolutely very, very volatile and non-linear, so very hard to, Our intent, yes, guidance too hard to give at this stage.
Okay, great, sir. Thank you for answering all my questions. All the best to you.
Thank you. The next question is from the line of Pritesh Chheda from Lucky Investments. Please go ahead.
Sir, just two interconnected questions. So, on the summer portfolio or the summer brands, let's say the competing product class, not the competing product classes, but seasonal product classes, unlike you had even a tougher time for the last couple of years. For us, it's not grown. So is it fair to assume that, we are, at least for this year, we are in for a fairly stronger growth in these portfolio, and they form a significant part of your portfolio and hence the overall growth. And by virtue of the fact that they are a higher gross margin vis-a-vis the company level gross margin, so your initial feedback which you gave that, you don't want to guide on the, reverting GM back to 55, but considering that they are a fairly high gross margin, you have that lever in terms of product mix this year as well.
So you are asking two things. One is the seasonal products performance and its impact on the gross margin. So seasonal products have started off well, and we are quite hopeful that the whole season will play out. Very hard to say how the demand happens, because just for you to and for everyone to see that seasonal products have a very inherent thing that they have a short window. Typically, say a consumer buys 1.5 pack in a season and it is re-recruitment. So we are hoping that we'll be able to recover back a lot of those lost consumers over the last couple of years, and we are quite hopeful of that. So we remain as optimistic as you suggested. And we were also hopeful that there will be operating leverage and a positive margin impact on that. But it has to play out as we hope it plays out in the top line.
And your comment on you have covered cost issue on each brand except Complan. So for this 350 basis drop in gross margin, do you want to indicate that the price increases on all brands except Complan has been taken care of? That's how we should interpret as on date based on whatever the material prices are?
Yeah, largely we've covered most of them at a individual brand level. There may be a small here and there, but largely we've covered most of them.
So these would have happened in the preceding quarter, which is the current reported quarter, whose benefit should now flow in. That's how it is?
So it has already happened in the last quarter, and substantial benefits have flowed in. Some more benefits yet to go, but substantial benefits have flowed in.
But sir, despite that, there was a 350 bips gross margin drop, so I couldn't interpret that one.
So there are also product mix impacts which come. So there are a mix of 2 or 3 factors. We also seen across FMCG and us similarly that there is a certain reduced volume impact, and therefore that's also a mix impact where certain product categories also play out. So I think we're largely covered. We had taken at an estimate level of about 7.5% price increase, of which 5.3 has played out. Let's see how this remaining plays out, assuming the same mix and planned numbers play out. We'll see. And we are also on the conscious of tracking each of the product because there has been further cost increases. We will act anywhere we see there is an opportunity to take further increases. So it's a very dynamic situation given every day we have new news. Like mid of the last quarter, we saw this Ukraine crisis. We've seen packaging price going up because of led by crude. So some of these are dynamic in nature. We are conscious and acting on each one of them as we speak.
Okay. And sir, our hypothesis that Nycil and Complan, Nycil and Glucon-D are higher than company level gross margin, at least that assumption is correct?
That's correct.
Okay. And lastly, what will be your debt repayment schedule or plan for FY23?
So debt repayment schedule will be on a gross debt basis, will be debt free by mid of the next calendar year.
So FY24, which means?
Yeah, 20. So mid of the next calendar year, I am saying that so in calendar year 23 by June, July will be debt free.
Will be debt
on gross debt basis.
Okay. Okay. Thank you very much.
Thank you. The next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi team. Thanks for the opportunity. My first question pertains to market share. So among our portfolio, which brands would have gained market share in this year and which would have lost market share?
Clearly, Sugar Free and Everyuth have gained market share. We have also marginally, I think we maintained volume share on slightly dropped, while value has slightly dropped, but that's pricing as captured by Nielsen, but their volume has maintained closer to 37%. Similarly, Glucon-D, the shift is about 0.1, 0.2, so largely maintained. Complan has dropped a little bit, a few basis points.
Okay. So second question is that since the acquisition happened, we did not have a single summer which was a normal one. And as the previous participant also alluded that the large part of our profitability is also summer dependent. So now with a very normal summer, in fact, more than normal summer going along, do you feel that that ambition of our EBITDA margin also moving back to 22%, we'll have some definite directional move in this year, and if it has to happen, this is the year where it should actually surface, or you believe that there'll be some headwinds which might derail us from achieving that ambition?
So I think, like I said, intent-wise, yes. I think when we get the full revenue, the operating leverage also plays out. We are acting also on the gross margin. So these are the things that will matter for us to play out. The revenue, addressing the cost through taking the calibrated price increase and cost, and the operating leverage to play out. We are working on all three of them. We are hopeful that directionally this year should move in the right direction at our operating margin level. But I mean, last few quarters have taught us that you can plan for something and it can be different. So I would say I stay cautiously optimistic.
Okay. Sir, are you optimistically cautious or cautiously optimistic? In the sense, what I'm trying to
play of words, beyond a point, I can't. Yeah, but I'm really working. We are really committed on that. The challenges are at multiple levels, both from a demand side and the supply side, and therefore it's a hard journey for the entire management team to navigate it, holding a market shares and profitability together.
So I think let me add to what Tarun is saying. I think what we have to all understand and what we are also getting to see somewhat in the market is that two bad summers. Obviously, we have seen good traction this year, but we have to wait and see that these businesses remain sticky because 2 years the habit formation may have changed in consumers and they would have moved away from something. So I think it's been a good start, but we have to wait and see. That's why I think it's very difficult to predict what happens for the full summer. But the brands are very strong and strong market leaders, so we believe that they will do well. The second thing that is a challenge is with the inflationary pressures, the price increases, and overall increases and cost of living increases that is happening for any consumer. The consumer has only a certain amount of money that they can spend. While many of our products are not discretionary and almost in the, not, I won't say essential, but near to essential category, we would see less disruption, but we still have to wait and see how this inflationary pressure affects the consumer demand and consumer uptake. So I think looking at all of those things, I think it's very difficult to predict how the year would go. But I think the brands being market leaders and mostly being in the areas of not only being, I'm now saying they're essential, but they're important. I think we would hopefully tide over this difficult inflationary pressure that we are seeing.
Fair point. And the last one on capex. In FY22, we did a capex of 75 crores, which was materially higher than our past run rate of 25 to 30 crores. So any mega capex which we missed out on earlier calls?
Yeah, one mega capex that we did talk about it earlier, that it was building, R&D center, which is state-of-the-art R&D center, and we consolidated a Rabale unit and Ahmedabad unit into one, and we now have Ahmedabad R&D center, which is newly built up, where we have spent 40 crores. If you take that out, then the capex is almost normal, which is 30-35 crores.
Okay. That's all from my side, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Kaustubh Pawaskar from Sher Khan by BNP Paribas. Please go ahead. Sorry to interrupt, Mr. Pawaskar. We are not able to hear you.
Is it fine now? Hello?
A little better. Please proceed.
Yeah. So my question is on Everyuth face wash. Have we gained any market share in Everyuth face wash this year?
Yes, a small percentage. It is few basis points. We are seeing a face wash growth in the last financial year improving over earlier years, but it's too small for us to make a large point to the investors at this point. But we do see some of the benefits of distribution coming over to face wash, but I think it's too early to be satisfied with it.
Right. And what was our raw material inflation in FY22?
Up to 3%. 2.5 to 3%. Yeah. So in FY22-23, the raw material inflation on a FY21-22. So on this is about 21-22, right? Yeah. In FY21-22, the raw material inflation is 2.5 to 3%.
Okay. And in quarter one, it has gone up by another 4%, so you have taken 7.5% kind of a price increase. Is it right?
Cover that. Yeah.
Okay. And my last question is on the distribution. How much is our current distribution reach? And for last couple of years, I think we have been focusing a lot in expanding our reach. So what is our current reach, and where do you see our reach going up in another 2 years?
So distribution we measure at two levels. One is our internal actions, which is direct distribution, and the overall reach as reported by Nielsen. I think as reported by, if we consolidate all our brands, it's reported at close to 2 million. My estimate is it will be higher, and we'll work with Nielsen to get the right numbers at a total level. Our own direct distribution is more than 500,000, about 5.5 lakhs. And we have planned to increase in this in the coming financial year by another 100,000 direct distribution points.
100,000.
I think our aspiration is to hit 1 million direct distribution over the next couple of years.
Okay. Thanks for giving me that.
Thank you. A A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Selva Muthukumar, an individual investor. Please go ahead.
Hi team, thanks a lot for providing the opportunity. Just I have two questions regarding how much debt we have as of now. My second question regarding Doodh Shakti ghee. So what kind of strategy you are planning to capture the market share, because most of the ghee market share is regional fragmentation is oriented. So what kind of strategy you are planning to capture the market share? Can you elaborate on this? Thank you. Thanks a lot.
So currently we have about 250 crore in the book. And about the Doodh Shakti, I'll hand over to Tarun sir for...
So for Doodh Shakti, our focus is two parts. We are focusing more in the regions surrounding the north and west, because that's where it is produced largely in Aligarh. So we are not going everywhere. We're also focusing a bit on the organized trade, because that's where our strengths are. Our aspirations are still very small given the size of the category, because we have limited production. But our fundamental focus is that we provide good quality ghee, which is sourced from the land of Braj, to a more discerning consumers. And I think we've got good response so far.
Okay, thank you. Thanks, sir.
Mr. Alok Shah, your line is in the talk mode. Please go ahead.
Yeah, hi. Thank you for the opportunity.
Sorry to interrupt, Mr. Shah. Sir, there's a lot of disturbance from your line.
Yeah, is it better?
Much better. Thank you.
Yeah. Hello, team. Thank you for the opportunity. So my first question is on sugar-free. In the slide deck, you mentioned that sugar-free has the potential to become amongst top 3 global brands. So wanted to check, apart from Splenda, which would be the other brands in the artificial sweetener category?
So from a global brands, there is Equal, Canderel, Splenda, which are the top 3 players. There is also some regional players like something from Indonesia which comes, and there is a European brand. So sugar-free will be in the top 5 to 6 players globally. I think as we scale up in India and also in our focus international markets, we do believe that we will be able to scale up. But these are the brands.
Okay.
Equal, Canderel.
Got it. So my related question was actually in terms of penetration, right? Now, sort of 20-22% kind of penetration in India, which otherwise is heavy on that. Hello? Yeah, can you hear me?
Look, your voice got missed in between. So could you just repeat?
Okay. Yeah, sure. Sorry. So my related question is that the penetration of sugar-free or artificial sweetener in India is, around 20-22%. Now, wanted to check what will be the penetration of artificial sweetener in some of the countries where, say, Equal, Splenda, etc. are quite high. And, what is it that we will need to do to increase the penetration? So is there a different playbook that we will need to use now going ahead, or how is it like?
So I think one of the largest markets for sweeteners or sugar substitutes is largely US and part of Europe, which are anyway more developed markets, and there it's not just as sweeteners, tabletop sweeteners, but also a lot of consumption happens through the culinary route as well. In India, I think we've actually got the right approach of balancing between diabetics and passive health seekers, which is balancing on the lifestyle and the diabetics. And our portfolio right now is split between 50-50 between the two. We are taking actions on both sides, on the diabetics as well as the health seekers. Some of the biggest headwinds that we face in India, which is largely a thing that comes from US-led information, is the negative impact of using some of these sweeteners, which impacts the belief on or trust on sweeteners. We are taking sufficient actions to drive that by reaching out to diabetologists, circulating information on the safety of these products, as well as the consumer consumption, trial generation, and distribution expansion. I think our playbook is already in place. It's just these negative headwinds which we have to keep overcoming, which we have taken a concerted action over the last 3 to 4 years. We've seen some improvements. I hope it will snowball into a larger number as we move forward.
Got it. And any then plans to also, accelerate the presence in the HoReCa or the culinary segment, where our share, I think, would be quite low currently?
So HoReCa actually is negligible. It's a very small thing. Largely, HoReCa uses sugar substitutes in two ways. One is with the tea and coffee, the sachets that get sold, where we do reasonably okay. Of course, some local brands come in between. Our major effort right now is, as we are building our food service portfolio, is to also get sugar-free consumption in terms of making those culinary dishes, which is a hard journey because typically it costs 2 to 3 times for some of these guys to switch from sugar to sugar substitutes. Also, sugar is a good filler of some of these desserts. So it's a little bit of harder journey, but we are at it. I don't see it as a big revenue driver, but I see it as a major influencer in conversion for retail. So we stay on course on that as we move forward.
Yeah. No, so what I was trying to get at is because, these days we see a lot of products, food products with sugar-free or low sugar, etc. So they would be substituting it somewhere, right? So I thought the revenue for them or the cost to the consumer for them is, at least 1.5, 1.8x the normal variant. So, so that's why I was just checking that, is that a big potential that we are tapping into, or? That's what I wanted to check. Okay.
So, I think there is potential there. We've been working with some of these players, including, for example, we have a tie-up with Have More Ice Cream, where they put a sugar-free branded product and we supply to them. So there is clearly potential, but they tend to buy a lot. Several players tend to buy from local players and more at ingredient level. So we're working on it. We'll see if we can tap that potential also substantially as we move forward.
Got it. My second question was on the prickly heat powder category. So, this is on the shelf. I see a couple of new brands like Candid, Glow Clip by Cipla, and now Imami has acquired Dermicool, right? Now, of course, maybe the competition may not heat up in this summer, but, next summer, maybe we may be seeing a different competitive landscape. So how do we plan to maintain our shares over here under Nycil brand?
So, Alok, the good news is that Nycil is one of the strongest brands in the category in terms of equity value. In fact, before acquisition, the brand was doing 29% volume share. In 3 years of our acquisition, it has touched a 37. Our direct distribution has gone up. Its total reach has gone up, which shows that because of the limited reach, because Heinz was a food company, so with the limited reach, it was struggling. With the support and the focus that we have on this brand, we've been able to scale up. Of course, competition will come, and we do see what you are saying. And I think somewhere that may also help us grow the category faster, because earlier the focus on category building was much lower. So I'm quite, if you ask my point of view, I think I'm quite optimistic of this brand driving the category growth up and also gaining market share, because our distribution reach has started building up. Earlier, our numeric was, despite being a much larger player, almost closer to the number 2 player. Now our numeric is shooting up. Our weighted distribution is much higher. So I'm quite optimistic of how we will be able to navigate the competitive situation. And if it grows the category, it's great for everyone.
Absolutely. And my last question was on, while Dr. Sharvil did allude that, Glucon-D and Nycil are sort of essential, but they are in some sense quasi-essential also. So I just wanted to check what would be the rural saliency for this product, because if there's some sort of an income distress, then, this quasi-essential product also sort of, there's cutbacks over there also. Just wanted to check that number, if at all.
So I think, first of all, I think our rural saliency is highest in Glucon-D and Nycil. they used to operate at 30% plus. In fact, Glucon-D used to be 33. As the categories shrunk in last two summers, it went up to 39. And even Nycil was 32-33% plus, the prickly heat category. Now the point is that should I take the last 2 years or maybe 2019 full year, it's hard to say. But the fact is that rural saliency is reasonably high, and we are quite conscious of the impact it will have on these brands. So we will see how it shapes up. The rural saliency of sugar-free and Everyuth and Complan is on the rise over last 4 to 5 years. We've been growing the rural saliency of these brands, and we have seen a much higher growth. Whether it's Everyuth, Scrub and Peel Off, the sachets are driving the growth because of the small pop strata and the rural. Sugar-free has grown from 14% to 18% over last 4 to 5 years in rural saliency, and so has Complan grown. So rural will become increasingly more important, and it therefore worries me if the rural is struggling. But I think by our focus on improving our distribution, doing the right things, we may be able to overcome this in short to medium term.
Got it. Thank you very much, and good luck for the future quarters. Thank you.
Thank you. The next question is on the line of Nikunj Gala from Sundaram AMC. Please go ahead.
Yeah, good evening, everyone. I have just one question on your trade payables. We have seen the last 3 years it is continuously declining. So just want to understand, the exact reason for this, and is this a number to work with going forward also?
Yeah, so in the last couple of years, we were very cautious during the COVID times, and we were controlling the payments because we were prioritizing the payments which are very critical for the business. And this year being the usual year, especially in the month of March, I mean, we paid out on time to all our suppliers, and therefore the payables have come down.
And therefore this could be a trend you could assume as a fair trend to assume.
Okay. So is it fair to assume that, earlier we were negative working capital cycle company, so now 24 to 25 days of working capital positive one, that would be a sustainable number going forward?
Actually, earlier also we were not working capital negative. Last year, if you talk about, we were at 20 crore.
Yeah, apart from the last year, I was asking.
Yeah. Apart from last year, yes. And now, there are a couple of things. With the new modern businesses like modern trade and e-commerce, which is growing, then the GT, then, it's increase to the working capital, it gives rise to the working capital. That is number one. Number two is that, there is a receivable at the end of the year end. We did give some credit to our receivables, which is a one-off incident, and which, for which you can reduce your, working capital number.
So just to add to what Umesh has said, I think March, while for us is a financial year closing, but it's also peak of the season, where our stock levels actually shoot up for the summer products. Some strategic reserves for post-flush season on the milk-based products also go up. And therefore, we tend to have a closing of the financial year with a higher working capital, but which comes down substantially in the later part of the year. So it's a cyclical in nature, but for the end of March, you will see this as a trend. Also,
that point, sir, but that's a every year phenomena, right?
Yes, and that is how it will be. And plus what is driving the numbers up is also the structural movement up of the organized trade, which we are dealing directly with. So these are two key reasons for moving our closing year working capital.
Yeah, structurally yes, but right from current number of days of 26, you can assume around 20-22 days.
Okay, sure. Okay, yeah, thank you.
Thank you. The next question is on the line of Ekta Sanghi from Vallum Capital. Please go ahead.
Hello, sir. Thank you for the opportunity. I just have two questions. One being that after our HIPL brand acquisition, have all the distribution synergies been fully leveraged? Earlier we had some issues in the healthcare professional channel. So can we say now that all those issues have been smoothened out? what is...
Yes, Ekta, I think all the distribution synergies have been fully leveraged from all retail environments, REs as we call in our distribution terminology, both grocers, chemists, cosmetics, modern trade, e-commerce. In fact, we've been able to leverage everything. Healthcare also, where we have leveraged the group's strength in the healthcare professionals for Complan toddler-based product. I think we're leveraging in terms of at least outreach with them. So we are at a full value out of them.
So for the muted volume growth that we saw this year, this quarter, this distribution expansion has not really contributed to volume growth. Is that a correct way to look at it, or would it come in the coming quarters?
So I think what we need to look at is one quarter standalone will not be an impact. The last distribution drive was almost a year back, where we had added from 3.4 lakhs to about 5.5 lakh. We had completed almost 13-14 months before back from today. And we've been able to gain reasonable value out of it, where we've seen almost high double-digit growth on Complan over 3 to 4 quarters. We've seen good growth in Every Youth. Even Sweeteners has gained value out of it. The last couple of quarters has seen the impact of what is really happening on the demand side, which is impacting, like I explained to you earlier on the call, how the HFD categories has practically degrew by 2% in the last quarter. Now, some of these factors are very hard to overcome in this short period of time, and therefore, to see the full impact of our distribution, you have to see as a full year. Also, GT generally across the industry has seen muted numbers over the last couple of years, where the organized trade has actually grown. And if you look at our presentation, where we've talked about a substantial increase of modern trade from 14% to 18% as a share of our business, has been driving growth for us more than general trade. So that is the impact of a mix that has got impacted. So I think distribution we will continue to drive, but it's not that linear from that point of view at a quarter to quarter level.
Okay, thank you. Understood, sir. And also just one last question. So going forward, which brands in our portfolio do you think are the strongest and would be the biggest growth drivers?
So it's a hard question to answer. I think because I actually have aspirations of double-digit growth for each of the brands. Complan and Sugar Free in last 2-3 quarters have had a harder journey, but I think they should be back on track basis of actions that we've talked about. And with the summers, I think even Glucon-D and Nycil should have a good run. Nutralite and Every Youth continue to have a double-digit growth despite all the challenges. So if you ask me, I don't see a big challenge at a Sweetener or I think any of the brand levels. So I think we should be in next 12 to 24 months should see a double-digit growth across all brands.
Thank you so much.
Thank you. The next question is on the line of Shirish Pardesi from Centrum Capital. Please go ahead.
Hi, good evening, Tarun, Dr. Shalvil, and Umesh. Thanks for the opportunity. Just 2 questions. The first is that finally we are seeing...
sorry to interrupt, Mr. Pardesi. So we are not able to hear you clearly.
Yeah. Good evening. Thanks for the time. Just 2 questions. One is on the international front. Finally, we are moving something. Tarun, my short question on the international front is that what product assets we have introduced in international market, and in the medium term, maybe 2 to 3 years, what kind of revenue share we are expecting?
So I think for international business, our key drivers for this business are 2 brands, Sugar Free and Complan, which are driving this business. Sugar Free franchise constituting both Sugar Free sweetener, the tabletop sweeteners, as well as the extensions, which was chocolates, and now we've launched the cookies and spreads. Complan by itself has different offerings across markets from Africa to Middle East and New Zealand. So these two are the key drivers of our business. And we will be looking at more extensions around these two brands, of course, while growing other franchises as well. We have touched about 3.5%, 4%, closer to 4% in last financial year from international business. Our aspiration is to organically take it to 8 to 10% if we can. We will look at some bolt-on acquisitions if they come for these markets to drive these numbers higher. The top 5 markets constitute about 70-75% of our portfolio, so we will focus to that.
Wonderful. And my last question, you mentioned that modern trade has moved to 17-18%. That's correct?
That's modern trade plus e-commerce, so I would say organized trade.
Modern trade, alternative channels, basically.
Yeah.
Okay. And
it's about 14% to 18%. 14 to 18 over last couple of years.
And you mentioned the current inflation is running at 7.5%, and you have taken 4.5% price increase. Or you have completed 7%.
We have taken a price increase, which we informed last quarter of about more than 7%. However, the results show the benefit of 5.3%. This is missed out by the fact that some of it may play out even in the following quarters. Yes, following quarters as well as some mix impact also. So, but largely we've taken a 7% plus.
Sure.
And it'll play out.
Sure, Tarun. Thank you and all the best to you and the team.
Thank you. Thank you.
Thank you. The next question is on the line of Kapil Jagiasa from Edelweiss Financial Services. Please go ahead.
Thank you for the follow-up, sir. Sir, which brand across your portfolio would have gained in distribution reach over the last 2 to 3 years? I believe you had mentioned Complan had reached around 5.7 lakh outlets. So, Complan would be one, and what about Nycil or Glucon-D? Where would have they reached?
So Complan has gained post-acquisition by almost 25-30% in terms of distribution reach. Sugar Free has gained, not to my expectation, but it has increased. Everyuth has substantially increased in distribution. We were about 4.5 lakh. We've touched 6 lakh, so we've gained there. We have seen Nycil gaining substantially despite the challenges. Glucon-D has reduced the numbers from a peak of 2019, and the reason being that the category shrunk 30% in 2020 and not fully regained. So from a peak of 16-17 lakh, it was last year trailing at 12 lakhs. I'm hoping that this year we will see the highest ever numbers, so that will happen. Nutralite has gone up in terms of directory. So actually, distribution enhancement has happened across all brands, and we're quite happy with the progress on that.
Okay. Thank you. So my last question is, some of the companies have started mentioning down trading, some of the consumer companies like Relaxo and also some of the air conditioner companies. Any down trading being witnessed in our product segments like Nycil, Everyuth, or any other product segment?
So we've not. So we've seen the LUP is doing well across segments, but that's a larger trend if you ask me. In Nycil, we have seen our 20-gram portfolio, the 10 rupee price point, doing very well. It did well last year. It is doing, continues to do well this year. Early days, but we'll have to see how it plays out. We've also launched, in limited way, sachet for Glucon-D to see if there is a certain on-the-go consumption that it can drive. We've seen our sachets in Everyuth continuing to grow over last several years. So I won't say just one-off as a down trading. A little bit of down trading which is driven by competitive actions I have seen in the HFD category, health food drinks category. That is because the leader taking price down and driving a certain direction of movement. But otherwise, I think in any case at an overall level, there is a movement towards lower unit price packs, which some may see as down trading and some may see at the point of consumption, because it's also measured doses and there are several other reasons which drive those consumptions.
Okay, sure. Thank you. Thank you so much.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for the closing comments.
Thank you, everyone. Thank you for taking time and asking these questions. Wish everyone safety and health, and see you next quarter. Thank you very much.
Thank you. Ladies and gentlemen, on behalf of ICICI Securities, that concludes this conference call. We thank you for joining us, and you may now disconnect your line.